Welcome to the MaRS Best Practice Series. This is the Valuation Series. So we've got two. Today, biotech. Next week, cleantech and environmental science. So the idea is not just to look at valuation, that magic number that somebody comes up with to tell you what your company's worth, but to look at the broader investor interest in these spaces. And we're really pleased to be able to partner with the Toronto Stock Exchange and the TMX group for this. Because they bring a unique perspective on this, and one that's tightly connected to regulatory and issues in the Canadian economy. Just to give us a sense, how many people here are researchers in the biotech space, perhaps even in this building? How many people are researchers? Okay. Entrepreneurs in the space. Got your own business, looking to scale it? Investors? What am I missing? Legal? Yeah? Who didn't raise their hand? What am I missing here? So what are you guys up to? Commercial. Commercial? Okay, good. Okay, good. So I'd like to introduce Wayne Schnarr and Raymond King. I'll just read their bios, and then they'll talk a little bit about the scope of their talk today. We'll have time for questions and answers at the end. So Wayne Schnarr is a healthcare consultant and analyst with Equicom, the investor relations arm of the TSX. Wayne initially worked to isolate biologicals from animal tissues and human blood. After a stint as a lobbyist for the Canadian generic drug industry, he moved to the financial sector in '92, and he's been an analyst for 4 independent investment banks, interspersed between time with biotech companies, venture capital, and investor relations. And Raymond King, who's going to be speaking second, he's a senior manager with the Global Diversified Industries Listings Business Development with the Toronto Stock Exchange and the Toronto Stock Venture Exchange. He's been with the TSX for almost 10 years and is responsible for leading global efforts to attract new listings in the technology, life science, manufacturing, and broad industrial sectors. So we'll start with Wayne Schnarr.
Okay, I'm going to wander as I talk. Thank you, Joseph. I'm going to be talking about some public companies, and so I have to say, put up this disclaimer. This presentation is for general informational purposes only. I may mention some companies. Again, I'm not recommending buying, selling anything in the space. Here's a good definition around which my talk's going to be based today on what valuation is. And the key is keep in mind the 4 underlined words as we go through today. Qualitative, numerical, risks, rewards. In biotech, every product, every company, every target is unique. Got unique risks, unique rewards associated with it. That being said, despite the thousands, if not millions of targets and products that are out there, you can come up with a valuation process that you can use. First thing, I give a little introduction to capital markets. Some of you have a lot, some of you probably have relatively none. So I'm just going to provide you with a little bit of background on some things. This is the Dow Jones Industrial Average. If you were out here in the 70s and 80s, this thing was just flat. Way up in the 90s, and I would argue it's been flat with some ups and downs. This was the global financial crisis. Biotech was not immune to the global financial crisis. It had a major impact on the availability of funding for biotech companies. So biotech is not in isolation. This is something you really have to take into account. This is the S&P TSX 60. Slightly different. If you overlap them, you will actually see major differences. Pardon me. This is the Nortel bubble. Or the tech boom, if you wanted to call it that. In Canada, it was the Nortel bubble. You actually didn't see that on this chart because these were the big companies of the old industry, and there really was no bubble. This is commodities taking off, global financial crisis, commodities taking off again. Different than the Dow Jones Industrial, but still has a major impact on what's going on in biotech. because you're looking for funding from the Canadian capital markets as well. Pfizer, again, would have been flat, skyrocketed as a lot of the blockbusters started to actually show their potential, and to the consternation of all the shareholders of Pfizer, a nice downward trend. From a technical perspective, be interesting to know if you actually have a top and a bottom here, and whether that line continues going down. I would bet not, but it's just my personal opinion. But you can see how the pharmaceutical industry, the values of the companies have been decimated over the last 10 years. And that impacts dramatically, again, on the biotech community. Biotech does not exist in isolation. Where are valuations important? Some of you are investors. Valuation is important when you're looking at doing an investment. From a company perspective, valuation is important when you're doing financings, partnerings, or you're actually putting yourself up for sale. Who invests in these companies? I'm just going to broadly go through some of this as background. The key here, US, US, US. At this point in time, there is insufficient capital in Canada to fund the community. Any company starting up these days has to start going to the United States, even on their first round. You may not get any funding on your first round, but you got to go there and talk to people in order to get your money. The value of a company. We were chatting about it here just before. The value of a company is defined by who's willing to put in the next money. For the VCs, the private companies, what VC is going to lead the next round? They set the valuation. For a public company, on a daily basis, your valuation is established by the next trade. If you're going out to do a financing, whoever is going to be the lead investor in that financing, they set the valuation of the company. Put yourself in the mind of an investor. Why would you buy a company? And although I've said mature healthcare company here, could be any kind of a mature company. You're looking for two things. You're looking for capital gains from the share price going up. Like myself, who actually am going to start drawing a pension next year, I'm looking for yield in a lot of my investments. I want dividends and distributions. If you're investing in a biotech company, your focus is on capital gains. I can't remember, I don't think Amgen or Biogen or Genzyme or any of them actually pay dividends. The big pharmas do. Some of the healthcare service companies do. Biotech does not pay dividends. You're looking strictly for capital gains. You want the share price to go up. And that is the focus. There's no altruism, philanthropy, or anything from these investors. They're strictly there to make money. In order to make money, you have to be able to sell your stock. To sell your stock, you need liquidity. If it's a private company, you want to take it public. You want to go an IPO. And there have been periodic IPO windows, over the course of the 20 years that I've been in public markets. Right now, that window is slammed shut in Canada. The last finance IPO was MaRS in late 2007. There have been biotech IPOs in the United States. The ones that have gone up in price have been the ones that actually had approved products and sales. I'm not sure that there's been a biotech IPO in the US for a stage 2 or stage 3 compound, phase 2 or phase 3, which has actually gone up. Most of them go down when they start trading. The other option for getting liquidity is the sale or acquisition of companies. One of the old stalwarts of the healthcare industry in Canada, MDS, broken up and sold off. It now exists on the stock exchange as Nordion. The last major sale of a private company, Virochem, which actually came out of Biochem Pharma, to Vertex. We have a number of big public companies that have been bought over the years. Biochem Pharma, ALI was software out of Vancouver, ID Biomedical, Anermed, Arius Research out of Toronto, and Cryocath out of Montreal. I'm not going to spend a lot of time on this except for the last statement here. Rising resource commodity prices attract high-risk money. There's a lot of investors in Canada who have high-risk, high-reward appetite. They Found that from investing in junior mining companies, junior oil and gas companies. You've got a situation right now where gold's around $1,400 an ounce. Eric Sprott says it's going to 2,000 or 3,000. It's kind of hard to compete with the small cap fund managers, when they can invest in any gold company and make money on it, and you're trying to sell a biotech company to them. All that being said, there was a deal done recently where most of the funding actually came from a group of Toronto institutional fund managers. So they're not immune to it. It's just you have to present a really good story. The key is growth. You're investing in a mature company. You're looking for an increase. You're looking for an increase in the top line, in the bottom line, or in the yield. If you're investing in a biotech company, you're looking for an increase in the share price. Share prices move generally when there are clinical, regulatory, or financial events. In each one of those events, investors will pay for a potential in reduction of risk or increased reward. Emphasize risk and reward like I did on the first slide. Keep that in mind throughout the presentation. I was a stock analyst 4 times, and just a brief comment on what stock analysts put out buy, sell, hold recommendations with 12 to 18 month targets. They do valuations primarily on what we're going to go through for the rest of this presentation based on discounted earnings and cash flow. I always felt it was a waste of time doing that for a phase 1 company where the odds of it actually getting approved were 10%. I always felt that it was a more realistic way of looking at evaluation of a company, doing comparative evaluation with its peers, or looking what the next event that there was for that company and basically saying, I believe that there's going to be a positive or negative event, and this is what could happen to the stock price. The easy part, number crunching. People think, these massive Excel spreadsheets are the hardest part. They're actually the easiest part. Components of financial modeling and valuation. You've got the Excel spreadsheet, the easiest thing to do. The assumptions for the spreadsheet, a harder thing to do. And what you actually can do with those numbers. Got a valuation for a company. There's a context within which you can use it. It doesn't stand by itself. It's easy to create the spreadsheet. Open up Excel. Across the top, you put the periods over which you're going to do cash flows. In the vertical column, you put all of the different expenses and revenues that are going to occur, and you fill it in. If you really don't have any background in this, and you want to know what all the cash flow categories are, go to cdar.com, pull up financial statements for one of the public biotech companies. That'll show you what they should be. And if you want to get into more detail, go into some of the pharmas, and you'll get an idea of what those should be. But actually creating that spreadsheet, that's easy. Once you've got that, what do you do with it? And basically, valuations are all geared around net present value, which I'll talk about in a minute. Risk-adjusted internal rate of return, they're just different ways of crunching the same numbers. Payback period I've used when I was a manufacturing manager, buying a piece of equipment, how quickly does it pay for itself? And then Monte Carlo simulation, it's an automated structured sensitivity analysis, which if you really know the company you're working on, you don't need Monte Carlo. You'll know what are the most important things you have to vary in your models. Net present value. Give me $1 today, give me $1 every year in the future. That dollar that I get 10 years from now is not worth as much as the dollar you're giving me today. The difference being cost of capital, risk-free or risk-adjusted. Cost of capital, I mean the bank rate's 0.5%. Risk-free cost of capital right now realistically is 5 or 10%. Basically, what can you a company borrow money from at the bank? These are easy to do. Cash or any cash flow at the beginning of a period. What happens at the end of the first period, second, third, and could be you can do this in years if you want to do a quick and dirty analysis of something. If you've got historical sales data, you'll do these where N is on a monthly basis. Value of $100 received today, what's that worth in the future with a risk-free discount rate of 5%? You start going out worth less and less and less. And basically, when you're doing a model for a company's burning all their cash up front. They're getting cash from sales or royalties in the future. You have to take into account these discount rates when you're doing that calculation. Let's say you've got a product just entering the clinic. What's it going to be worth at the end of 8 years of clinical trials? Let's just say it's $1 billion that I'm going to get in 8 years. All depending on the risk, which is reflected in the discount rate. What's that $1 billion worth to me now? At a 35% discount rate, it's only worth $90 million. 50% discount rate, it's probably down in the $40 million range, which is nice to have that billion in the future. What's the risk associated with actually getting to that $1 billion? So, some words of wisdom. Anybody can do those financial models. You create them with very little solid information, and you got a lot of assumptions. So the quality of your model is based on the quality of your assumptions. The quality of your assumptions comes from asking the right questions about the risks and rewards associated with a product. These models are useless for doing absolute valuations unless you have historical sales data. They are really good for comparative situations. One being, for example, when you're licensing out a product, you've got a bunch of different deal structures. You could possibly do it. So you've got, you can compare the net present values of the different deal structures. The other one, which big pharma would go through on a regular basis, they've got a huge portfolio of products. They'll go through a net present value risk profile analysis, and they'll compare those products. And that goes on a regular basis every 3 to 6 months. And every time they do that, some products die because either the NPV isn't good enough or the risk is too high. Okay, the hard part, assessing risks and potential rewards. This slide deck is 71 slides. I'm not going through them all in detail. A lot of the information on them is for you to look at later and learn about all the different questions that have to be asked. The focus of the next whole series of slides is the questions you need to ask when you're looking at a company. Standard dogma, 10% of the products going to clinical trials actually make it. It's somewhere between 5 and 15%. It varies with the therapeutic indication. It varies whether it's in big pharma or little biotech. Nobody can pick winners on a regular basis, be it stock analysts or pharma. You cannot eliminate risk. You can mitigate it with portfolios. Pharma does it. Fund managers do it. And the key is risks can be assessed. You just have to ask the right questions. It's also a balancing act. Risks and potential rewards are not static. They change. Think of a drug being developed in a certain area. Competitive drugs are coming along. Standard of care may change. You've got more clinical data on a variety of products. It's not static. You have to do the risk and the reward assessments and then review them and revise them on a regular basis. I go through this in 3 stages, the 3 general categories of risks. Approval risks. Is the product going to get approved? What are the risks associated with that? What's the market potential? And then what are the risks associated which could impact the market potential? It's just a logical progression. There are probably many, many other ways of looking at it. I just find this is a nice logical progression through a series of risks. The approval risks, financial, regulatory, manufacturing, clinical, scientific. Right now, the 2 biggest ones, financial and regulatory. Money has always been the scarcest asset in the Canadian biotech community. It has been for the 20 years I've been involved in public markets. I expect it will be for the next 20 years. 2 types of funding. This is success funding. These are the places where you can get enough money to actually drive a product forward at a decent pace and come up with a product or a company at the end. Governments and disease associations, and there's probably some other sources, they have survival funding. They will allow you to progress a technology or a company, not at the pace you would like to do it. I'd even include the NIH in this, especially if they're going to run clinical trials for you. NIH never runs clinical trials on time. They always take longer than expected, so you can't count on an NIH trial for your valuation. However, they do great supporting data for you. Canadian biotech companies used to be able to go to the markets whenever they needed money and raise a year or two of cash. Occasionally there'd be IPO windows that would pop up and the private companies would be able to get public. The biggest window being 99 to 2001, we had the biotech boom that piggybacked on the tech boom. Companies always preferred to raise money in the capital markets and not partner. Different situation now. It's show me the money, please. I showed you that global financial crisis and the impact it had. Financing is now more difficult. Valuations are probably at the lowest level we've ever seen them. IPOs, as I said, they're impossible in Canada right now in the biotech space for a development stage company. The focus for the last couple of years has been on survival. And we've lost a few companies along the way, public and private. We're probably going to lose some more. This shows you the degree to which the funding has gone down. This is information from the Canadian Venture Capital Association website. If you look up in here, average 500 million a year. 2009 was 200. This one, I don't know where it goes. That was the first half, so it'll be somewhere between 200 and 300 probably. Public markets used to be about $1 billion a year for development stage companies. 2009 was 500. This is what it is for the first 3 quarters of the year. My guess it ends up between 350 and 400 for the year. So 35 to 40% of what it was there. So there's no question it's hard to get funding. And as a result of that, you have to ask these financial questions. Does the company have the financial resources to get to the next value-creating event, be that clinical or regulatory, with a little breathing room because not everything gets done on schedule? If they don't have the money in the bank, can they get the financing? If they do have the money in the bank and the event's positive, can they then raise that next round of money, which will allow them to get to the next financial event? So it's a series of financial questions as you walk down a subway. Well, basically, if you want to think of clinical development as a subway line, you're going from station to station. Each station's a clinical or regulatory event. You have money to get to the next station. Sources for public companies, cedar.com is the Canadian companies. SEC.gov gives you the information on the US companies. Partnering, there's 4 slides here. I'm not going to spend a lot of time on it. Partnering is a major source of potential money. There are problems, well, partially because the buyers, the pharmas, see thousands of opportunities every year. I used to do licensing. I used to teach licensing. This is something which I'd have to deal with in another course. So these are here for your information only. Regulatory risk. Is there a pathway to regulatory approval? That's the critical question you have to ask. And then there's various components of that question. What do you need to get approved? It's actually a set of moving goalposts right now. These are your basics. 2 well-controlled clinical studies, prove safety and efficacy. For cancer and a few other diseases, you probably get away with 1 study. But that's changing all the time. And so you have to pay very careful attention to what the FDA regs are. FDA website is a beautiful source of information. EMA, not as good, but they generally follow what the FDA says. Therapeutic indication. If I used to look at a company and they were doing a clinical trial for an indication and I'd never heard of it, good probability the FDA had never heard of that indication either. The FDA is probably not going to know how they're going to approve that product. If the FDA's never seen it before, it's a risk. Has another company taken a product into phase 3 and failed? Why did they fail? You know, was it the product? Was it the indication? Was it the design of the phase 3 clinical trial? And you have to go back and look at all that information on other companies so you can assess the valuation of the company you're specifically looking at. Clinical design. You're looking for differences. Differences mean risk. So if you've got products already approved, take the design of a clinical trial, compare it to the clinical trials run by companies that are approved. Are there differences? Take the phase 3 clinical trial structure, look at the phase 2 clinical design that a company ran. Are there differences? And explain the differences. And if you can't justify the differences, it's a risk. Standard of care. Is there a defined standard of care? Or are there multiple products approved where there's multiple choices for first line? You know, and if there is no standard of care, are you going to have to run versus placebo? And there's becoming more and more of a resistance at the FDA to running placebo-controlled clinical trials because they don't reflect clinical practice. Primary clinical endpoint. Cancer, it's easy, survival. Although in the odd cancer in which you can get away with progression-free survival or a response rate, but that's becoming rare. So survival, you know, is it a clinical endpoint that's readily assessed? Does it involve a lot of patient feedback? Is there a huge placebo effect? If you're running pain clinical trials, the placebo effect could be in the 35–40% range. So you have to take that into account, you know, when you're perhaps considering an investment, you know, cancer company versus pain company. Statistical analysis. There are, and again in pain trials, how do you treat dropouts? You know, a person drops out because it's not working for them, or a person drops out because they're feeling really, really good. You know, in one case the product failed, in the other you know, it worked. How do you treat that? One of the things the FDA has developed is the SPA, Special Protocol Assessment, where you answer a lot of the questions I've just walked through and define that if you run this clinical trial and you meet your primary clinical endpoint, you've got enough to be approved. You're not arguing about design or endpoints or stats analysis at the end of the process. You do it up front. Clinical significance, you'd expect that 10 years ago it wouldn't have been part of an FDA advisory meeting or an FDA decision. Clinical significance is coming up more and more at the FDA. You know, is there a clinical benefit? Not just getting another product, the 8th statin or, you know, 10th ACE inhibitor on the market. I'm not sure that another statin or another ACE inhibitor would actually get approved at the FDA right now unless there was a massive clinical or safety benefit. Safety profile. There is no question the hurdle at the FDA has gone up for chronic medications for diseases that are not immediately life-threatening to the patient. You know, so certainly in the you know, cholesterol lowering area, HDL raising area, you know, cardiovascular, you know, the hurdle is much, much higher than it was 10 years ago, and it's a risk. And there's a cost associated. You know, you have to run another 2,000–3,000 patients. That's a cost. And you have to take that into account when considering the valuation of a company. Manufacturing. I was a manufacturing manager in GMP facilities for 5 years. So I understand this. A lot of companies forget about manufacturing. You have to have a GMP process and you have to have a GMP facility. And the product that you use in phase 3 clinical trials has to be done on a commercial scale in a facility. Or when you finish your trial, you're going to have to wait while a facility is being built. Hemosol faced this problem when they were going into phase 3 with their cross-linked hemoglobin product. Question was, do you pardon me, build the facility before the phase 3 so that if the phase 3 is successful, you can immediately launch. Or that's a lot of money to sink up front into a facility. Or do you run the clinical trial and then probably have to go to market for the first 3 years at a sub-commercial scale and before you can get your commercial facility up. As it turned out, Hemosol built their facility. The product never made it out of phase 3, and Hemosol is now Therapure, a contract research and manufacturing organization. A couple more things on manufacturing risk, which I'm just going to leave for you to read after. Scientific risk. I don't care how many publications there are out there on a product or a particular target. These are some basic questions you have to ask. If you answer yes to all of them, you've probably got a reasonable level of scientific risk. The most critical one being, do you know how the drug works? Do you know what causes the disease and how the disease progresses? Because if you know those answers, you can probably design clinical programs that have lower risk. Manufacturing costs, not a problem with most products. Certain types of products it is. If you look at Provenge, Dendrion's therapeutic prostate cancer vaccine, it's autologous. It's made from individual patient cells. High manufacturing cost, which is why Provenge is charging, I believe, $90,000 US, $30,000 for each of 3 injections. You have to pay attention to it. Market potential. This is the second of the 3 areas that were in this last section where you have to ask the critical questions. 2 approaches to it. You can start with the patients and work your way down to what a realistic patient population is, or you can start with sales data on drugs that are already approved for a certain indication. The number of patients that have a certain disease is not meaningful information. What's meaningful information is how many patients are diagnosed with that disease. Because if you're not diagnosed, you're not treated, and if you're not treated, there's no sales of a drug. And then you can work through it, segmenting the population by disease severity, first-line therapy, second-line therapy. And then you come down to a realistic patient population. You need information on the drug costs. Most companies now publish, when they have a product approved, what the average annual cost of therapy is going to be. You can find that in the press releases. If you don't see it there, you can probably find it in formularies. The Ontario Drug Benefit Formulary, it's online. It's got a lot of information in it. There's other formularies out there as well. Nice in the UK put out some very nice studies as well. If you want to buy things, there's things like the Red Book, which have the US prices in them. Red Book's actually not that expensive relative to some other sources of information. Now, if you want to use a sales-based approach, you're okay with financial reports by public companies for their top-selling drugs. Okay. Merck, for example, or Pfizer, any of the big pharmas, will, top 10, 15 drugs, they'll break out the sales, US, rest of world, quarterly basis. You can run some pretty good models. If it's below a certain level, you won't find the information unless you pay exorbitant prices for these types of resources. Stock analyst reports are a relatively free source because they actually buy this information. So if you can actually, get on the distribution list for some stock analysts or access it through things like Capital IQ, which you also have to pay for, but it's cheaper overall probably. You can get this, and then you can work from that sales information to model out, what the potential sales of the drug you're looking at are going to be. Market risks. What risks that may affect the market potential? First in class. Always good to be the first one in to the market for your product. You get out there, you get to establish it in physicians' minds. And it's always harder for second, third, and fourth products if they're just equivalent to take market share away. If you're going to be third or fourth to the market, and you take a look at the size of the market, you take a look at the marketing costs, is it worth actually finishing off the development of that product? Pharma goes through this on a regular basis. They will kill products at any stage in the development process if they run that NPV. If that NPV ever turns negative, it's dead. Actually, if it drops below a certain level, it's dead. They will just terminate it at that point. Best in class. Usually some product emerges as the best in class, and you can usually judge from probably phase 2 data which one that's going to be. So you look at it and you say, okay, best in class might be third to market. If you're going to be fourth to market and you're an also-ran, is it worth finishing it? And that's one of the things you look at. Competition. Always have to look at competition. 3 levels. Currently approved drugs, drugs at the same stage of development, drugs that are much farther back. You don't need to spend as much time on the drug candidates that are at an earlier stage of development unless something really looks like it's going to dominate a therapeutic category. Currently approved drugs are only competition if you're trying to displace them. If combination therapy is becoming very common in many, many therapeutic indications. So you've got a situation where some of them are competition, some of them are just drugs that you're going to be using with your drug. Depends on whether you're going to be first line, second line, or third line, whether a drug is actually competition. Easy to get lists of currently approved drugs. This is one of the best places to find it. Drug candidates, clinicaltrials.gov, the best source of information on products that are in clinical development. You do a search on a certain type of cancer, you're probably going to come up with 10 to 20,000 hits. Then you start to narrow it down by, and there's a good section on that for narrowing it down by who the drug's sponsored by, what stage of development, and you can get some really good information there. Now you have to work at it. There are also purchase reports, anywhere from $5,000 to $10,000 a piece. But if you've got the time, clinicaltrials.gov. And you can assess them by, if they're the same biological target, probably competition. Same chemical class, or they're different. And you can look at safety and efficacy in, phase 1, 2 clinical trials. Reimbursement. Never used to be a problem. Although even 20 years ago, it was starting to come out even in the Canadian market. I remember when I was a lobbyist for the generic industry in Canada, BC Pharmacare, their drug plan, basically said for all of the proton pump inhibitors, we're only paying for the cheapest generic of, at that point, probably ranitidine. So comparative therapeutic testing, restrictive formularies, major source of fights in the US right now. It will happen there eventually. It might take 10, 20, 30, 40 years, but it will happen because it's happening everywhere else in the world right now. Patents. These are the questions, the key questions. Is your product covered by issued or filed patents? The other question you also have to ask is, does your product infringe on any other patents? And that's the freedom to operate opinion that a lot of people forget about. And given the complexity of all the patents that are out there, it's a critical thing to ask. But then ultimately the question is, assuming your product gets approved here, how much market exclusivity do you have from patents, patent extensions from both the pediatric and regulatory extensions, and now data exclusivity. New chemical entities in Europe have 10 years of data exclusivity, plus I think a little bit more because the generics can't even file until that 10 years is up. And in the US, the new biologics rule, I believe it's 12 years plus, and I'm not sure that you can even file until after that 12 years is up, so you even get more than 12 years. So good data exclusivity, which probably is worth more than your actual patent exclusivity now. In conclusion, I go back to my definition, what you have to look at. Qualitative, numerical assessment of risks and rewards. Anybody can crunch the numbers. Better assumptions will get you a better valuation. You'll get a better set of assumptions if you ask the right set of questions, such as the ones that I've been through. Thank you.
One of the things that I think a lot of people, certainly those researchers and the entrepreneurs in the room, need to start realizing as you look at the questions that Wayne was sort of posing up there is the minute you go out to raise the first penny of funding, you've ceased to be a research project and you've become a business. And one of the biggest problems that biotech companies in general are facing in today's marketplace, but have faced historically, is the fact that the PhD does not necessarily mean you know how to run a company. So you need to start looking at some of the dynamics that are in play there, given that the difficulty in the life sciences space and in sectors in general for the last few years has been particularly onerous and has had the most direct impact on the life science companies. We see a lot of companies coming to our marketplace in a variety of areas. What I'm going to try and do is very quickly go through the first two sections so you at least have a sense of who we are and what we do in our marketplace, and then get into the life sciences and talk in the going public section about one vehicle that a lot of life sciences companies do use on our marketplace, particularly on our junior board. I know most people have probably heard of the Toronto Stock Exchange. I guarantee you most people in the room don't realize how large an exchange group we are. We're actually one of the largest exchange groups globally, and the stat down in the lower right-hand corner really points to how large we are from a financing perspective. We are the 6th largest marketplace in the world in terms of equity financing. Admittedly, the bulk of that in the last year or so has been in our senior board as opposed to our junior board, but it's still, for a country of 32 million and our next door neighbor being 10 times our size and being the world's largest current capital marketplace, we still hit well above our weight. We do have 2 exchanges in our group, and I'll have a bit more information behind them. This slide really, though, is to point out where both our exchanges play. The Toronto Stock Exchange is our senior board, the one perhaps most of you are more familiar with, 160 years old, and it really does play in the same space as does the New York Stock Exchange and NASDAQ in terms of serving a more mature end of the marketplace. The Venture Exchange plays a very distinct role in our marketplace, and building off of a few comments that Wayne had, one of the issues that Canada has always faced, whether it's in life sciences or tech, is that from a private venture capital funding perspective, it has always been particularly difficult here to raise private venture capital. And the stats that Wayne showed for the last few years may be for that point in time, but it's a historical issue. Our venture exchange and its precursor entities goes back 100 years, and in the context of the Canadian capital markets really play the role of public venture capital. And this is where you see a lot of life science companies going public and using that particular board to get those, not necessarily the IPOs, which I will agree with Wayne is a very difficult market, but getting listed and being able to go back to the market on a consistent basis to raise those subsequent rounds of financing. That's what's keeping the life science companies going nowadays. A bit more detail, our venture exchange, again, our junior board, really for earlier stage companies looking for smaller rounds of financing. It's predominantly what we call a PIPE marketplace or a private placement marketplace as opposed to being an IPO marketplace. But 90% of the financings there are done in the form of private placement. So you're listed, you go out, you work with a pool of private investors, and you raise on average $5 to $10 million. Sometimes it's a bit smaller, and sometimes it's substantially larger. There's no limit to how much you can raise, and we have had life science companies raise in the hundreds of millions of dollars through a private placement financing on the venture exchange. So you're not restricted to size, but what it does do is serve those earlier stage companies at this point in their time, and as they grow and mature, then they progress or graduate, as we call it, up to our senior board. Another way to look at this from the perspective of life science companies is that you tend to see the preclinicals, the phase 1s, and nowadays also the phase 2s being on our venture exchange. And then as they start moving into phase 3 and on into commercialization, that's when you start seeing them graduate to our senior board, given the dynamics in the marketplace. This slide really just illustrates the fact that our venture exchange is for the very early stage companies. The majority of companies there are under 50 million in market cap, and as they grow, they, as we say, graduate onto our senior board, and by the time you get to 250 million, the bulk of the companies are on our senior board. This is an extremely active and liquid market, and this slide really to illustrate that regardless of sector, there are a very large pool of international players that play in our space. I think particularly important for life science companies to recognize that, as Wayne alluded to as well, when you raise capital in our marketplace, you're not just raising Canadian capital, you're tapping into a very international pool. And as you see there, anywhere between 35 and 40% of the capital and trading on a daily basis is coming from the international marketplace, particularly the US. So smart companies nowadays will look at one exchange but realize its impact in terms of their overall global financing. As you probably have always heard in the past, certainly with respect to any press, you know that we're sort of dominated by our resource sector, mining and oil and gas. Life sciences kind of skews down towards that end. In this graph, it's about our 7th largest sector. Life sciences for us is the 2nd largest sector after NASDAQ. So one thing to keep in mind is while NASDAQ may be the preferred destination, we tend to see a lot of the earlier stage companies coming to our marketplace. And they're doing it for one of 3 reasons. Clearly, if you're in this room today, you're talking about accessing capital. But for those companies that succeed and tell their story properly, you're also talking about liquidity and visibility. This slide sort of illustrates the point I made a little bit earlier. Last year, as you see, in terms of capital raised, overall, $65 billion. And that was a record for our entire 160-year history. It's also phenomenal when you consider that the first quarter of last year was essentially a nuclear winter coming off of the global credit crisis, but to raise $65 billion. This year, to the end of August, we're at just under $32 billion. So it hasn't been quite as active. What has helped our marketplace, whether you're in life sciences or just in general, is the fact that in addition to the strength of our capital markets, the strength of the Canadian economy has been attracting a lot of investors globally looking for very good growth opportunities, including in life sciences here. And so the fact that we didn't have any bank collapses or bank bailouts, and the fact that the IMF has voted our banking industry the top in the world for the last 3 years has meant there's a lot of investor interest here, hence the amount of capital you're seeing. Not going to talk too much on this one, but you see both Venture Exchange and the Senior Board, very liquid markets for those companies that talk properly. Analyst Coverage, if any company, regardless of sector, is going to list on any exchange, you have to be making sure you tell your story properly. And Wayne and his group at Equicom and Ross, they are experts basically in this space. They will tell you the consistency in getting your story out there, especially in the life sciences space where you're going to have significant gaps between event horizons, is important in order to sustain visibility. And those analysts out there that do cover the space recognize that. But if you don't tell your story properly, you're not going to get coverage at the end of the day. And the coverage is which generates the investor interest. It drives up your share price, it drives up your market cap, and it ensures that the next round of financing you do will be at an uptick as opposed to a down round, and you don't want to be doing that. It comes back to all your comments about valuation at the end of the day. Life sciences, we currently have about 136 life science companies on both of our boards. It's split about 2/3 to the Venture Exchange, 1/3 to the Senior Board. As of the end of last year, $11 billion in market capitalization. It was, as Wayne pointed out, one of the hardest hit sectors globally, not just here. In large part because I think a lot of the people in this space, those companies in this space, have not really recognized the risk profile of the investors and their aversion to anything that's perceived as high risk in today's marketplace. To Wayne's points there, you need to be doing your research and telling your story properly because a lot of people, quite frankly, assume that there's a 10-year horizon before they're going to see any return on an initial investment. And nowadays, nobody is going to put money into something they perceive as being 10 years away from any return on their investment. So you need to be doing your job properly. On average, as you see here, 3 life science analysts covering each life science company. Fairly robust market in terms of trading. And as you see there, just under $400 million in financing last year, predominantly, as I said, secondary financings. A bunch of reasons why companies look at going public, but essentially at the end of the day, it's all about getting the capital. And in the life sciences space, given the lack of private funding in many cases, including difficulties in getting some of the government funding, we see a lot of the life science companies coming to our marketplace to try and sustain their growth. Everybody talks about the IPOs, and yes, Wayne is right, it's a very difficult market to do an IPO in. But as I said, it's the private placements and the secondary financings that are crucial. One thing, and this is where I'm going to start talking more about the Venture Exchange, one vehicle that we do have that is very good for companies is this entity here called the Capital Pool Company Program, and I'm going to spend the next few slides going through this so you get a better understanding of what it can do for a company. It's a quasi-IPO, but what it really does is takes a lot of the risk out of the financing for a lot of companies. Some sort of issues, if you will, or some points behind the IPO versus the CPC. But the main point, which I did bold on the CPC side, is that certainly in an IPO market being closed, say in a case like the life sciences sector, the CPC program can actually take a lot of the risk out of the funding, if you will, for a company when a company uses that vehicle to go public. For most life science companies that have used this vehicle, essentially they take over a publicly traded cash shell that's been set up specifically to go out and identify good investment opportunities. And it has cash within it, but most companies will also do a concurrent private placement financing at the qualifying transaction stage, which is the coming together of the two entities. And at the end, once that's completed, you become a fully operational, publicly listed company in our junior board. The vehicle has been around for over 25 years now, so it's not new. It's well-oiled, it's well-regulated, but over 2,100 companies currently have used this as a means of going public, and quite a number of the life science companies on both of our boards have used this as a means of getting publicly listed and then funding, certainly in the earlier stages. Bit of a graphic here in terms of the whole process, and I'm not going to really cover the whole thing. What I am going to do is speak to the last two bullet points here, which are the ones that are really relevant to the life science companies. And that's the process of the qualifying transaction, the merging with the cash shell, and then the aftermarket. The qualifying transaction, or the merging of the two entities, the private company and the public company, goes through essentially these key points here. Those founders of the CPCs have 24 months to essentially identify your life science company, if you will, in this case, as their preferred vehicle for vending their capital in. And if you agree to this process, then you basically go through this whole process of negotiating with them. And I want to make it clear, it is a negotiation process. We at the exchange have absolutely nothing to do with the negotiations. You have to make a decision as to whether or not it works for you and their terms make sense for you. They, in turn, have to make sure that your science makes sense and has some good upside potential, because they're not going to put the money in. And one of the things in today's marketplace for a lot of the qualifying transactions we are seeing in the life sciences space is that they're very leery of looking at anything that's in preclinical. They want to at least see phase one, and to Wayne's point, they want to see a portfolio of more than just one indication. Again, it's talking to the risk diversification in the portfolio. So those life science companies that are doing better in terms of this process are ones that have two or three indications, preferably in slightly different areas, so you're balancing out some of the risk of being too grouped into one area. At the end of the day, if you agree to this whole process and get listed, then you've got an access to capital. Some of the considerations for this, obviously, you want to make sure you have significant growth potential and a reason to be public. Just raising the capital for the sake of doing a little preclinical is not going to be good enough in today's marketplace. You have to have strong and coachable management, and this comes back to what I said a little bit earlier. Your PhD is not necessarily a guarantee that you know how to run a publicly traded company, and investors will penalize you for that. One of the things about the CPC program is that it will oftentimes bring in qualified directors and or qualified management to help run the company. And oftentimes we say it makes more sense for the scientist who may have set this venture up initially to step aside and become the chief science officer and focus on doing the research, and bringing in somebody who's qualified to run the company and get out there and raise you the capital. I guarantee you it's better to own, as the scientist, you can sort of control how much equity you have at the end of the day, but it's better to have 51% of something that's actually growing as opposed to 100% of something that's going absolutely nowhere. And I think a lot of scientists kind of lose track of the fact that they can actually get some value of their own research by letting somebody else come in and run their company for them and allowing it to grow. The CPC program, great for companies that are looking for $5 and $10 million rounds of financing. But as we all know, certainly in clinical trials, you're looking at about $1 billion over the lifespan if you're successful. And so it is a means of getting into the marketplace, doing those subsequent rounds of financings. As you grow, you moved on to the senior board, you tap into an international pool of capital, and hopefully at the end of the day, you become commercial. Some of the success factors behind all of this: lots of cash on closing, potentially. Companies that use this vehicle do get a lot of attention in the marketplace. Initially, it's making sure you deliver in the short term in terms of your business model. It's a reasonable valuation, but it's not always the maximum valuation, and I think a lot of people sort of lose track of that. Again, you will be benchmarked against North American competitors, not just Canadian, and they're not going to give you credit for the fact that you personally feel your time was worth $5 or $10 million, whatever number you want to throw out. It doesn't work that way. So you have to be a little bit realistic there. And then once you're traded, you have to make sure that you continue to tell your story properly. You will trade as a fully operational company, and you're going to have responsibilities associated with that, not just to your shareholders, but to us as an exchange, to the regulators out there, and potentially to any partners that you pick up as a result of this. One of the things that people lose track of when they look at going public is the fact that going public actually makes you more attractive to partners out there, whether it's in the pharma space, potentially partners in the R&D space, because they're able to better assess the value of your company. It makes it easier for them to invest their money in your company as opposed to you still being private. Difficult for them to get their hands on some numbers, and oftentimes it's that ability to actually use your listing as a means of building partnerships in the industry that help you sustain your financings going forward. And all of that can certainly be helped by a good IR program. Again, Equicom, one of the reasons I had asked Equicom to do this is because they are the top IR firm in the life sciences space in Canada. They know their stuff, and Wayne, certainly with his background, as you saw from his presentation, knows his stuff cold. The kind of guidance you can get from people like that will ensure that your ability to go back to the marketplace to raise those subsequent rounds of capital will be done, as I said, an valuation increase as opposed to a down round. And I think, okay, so again, some success factors. You need to be making sure you're consistent in your communication, even on a quarterly basis, even if you have nothing to say. Just indicating that you're continuing to do your trials is important. It's important to manage the brokers and the investors that are out there, and making sure that you are you're timely with your disclosure. The pitfalls, if you don't do that, is the fact that you'll become an orphaned company, or what we call an orphan company. It basically means nobody's trading you, nobody knows you exist. And in the life sciences space, it's oftentimes because, again, the scientists that are running the company do legitimately want to focus on developing their technology or their science, but they completely lose track of the fact that they need to be communicating to the marketplace, and they assume that everybody knows they're there. Keeping in mind, if you remember the stats at the beginning there, our total exchange has 4,200 companies on it. And the life science companies in many cases are in that sub 50 million market cap. It's very easy to get lost in the shuffle if you're not communicating properly. And again, market fluctuations, admittedly the last few years for every sector, including life sciences, has not necessarily been good, but if you're willing to sort of make the effort and weather the storm, it can work in your favor. I'm not going to touch on any of this. It is, again, in the materials that I think Joseph is distributing to everybody, but I wanted to put this slide in for those that wanted to have a look at our listing requirements on both the venture exchange and the senior board. The venture exchange, a bit more flexibility in terms of tiers. Tier 2 is for earlier stage companies. Tier 1 would be for slightly more mature companies in the context of the venture exchange structure. I would almost argue preclinical Tier 2, Phase 1 more Tier 1. And then our senior board, as I said, tends to be more for late stage Phase 2 going into Phase 3 and on to commercialization and the pharmas that we've got. So that was my end of the presentation, admittedly quite a bit shorter because I think the value in this session was really what Wayne wanted to talk about, and I just wanted to add the context of how the public markets look from a valuation perspective when you're sort of trying to look at the whole picture. So if there's any questions, I'll take those. Otherwise,
Yeah, we've got plenty of time for questions, so use this opportunity.
either for me or back to Wayne, actually.
Yeah,
So-
or either. And gentlemen, if when asked a question, if you could maybe just repeat the question for the benefit of.
Sure, I see two so far, one here and one there, so I'll start here.
Hi, I'm from the Investment Accelerator Fund here in MaRS. You talked a lot about the advantages of small biotechs or preclinical, getting clinical, going public, and there's a lot of advantages clearly. However, what are some of the drawbacks? The times that companies that are maybe looking at going public that they need to really consider, and maybe it's not the right time. So what are some of the factors that they should be looking at that they're not really ready to be going to market?
I think we're both going to cover this one. I'll start with some potentially obvious ones, but I mean structurally, in today's marketplace, you need to have a really good board in place, and you should have a board that's more than just a bunch of scientific advisors, which you do need to have, but you need to sort of fleshing out your board of advisors to make sure you've got people that can actually grow your business or help you grow your business in the commercial marketplace. And one of the drawbacks we oftentimes see is companies don't recognize in today's marketplace with the level of disclosure that's required as a publicly traded company that they don't have the right board of directors. They sometimes, quite frankly, don't have the right management team. They don't even have a CFO. So that's one of the big issues there. And that CFO really, I think, is critical because that individual will handle the bulk of the dealings with the financial marketplace and your investors and your shareholders. And if you don't have a good CFO, oftentimes, certainly in this space, companies really penalize themselves in terms of their ability to tap into the marketplace. If they're not willing to make the investment to structure themselves properly to be a business as opposed to a scientific project, then they really shouldn't be looking at going public at all. And I would argue in some cases, and certainly in today's marketplace, they may not even be a good candidate for private financing, which may make it increasingly difficult for them. You see this oftentimes, it's a bit of an aside, but it's sort of, you see the mindset or the difference in the mindset when you go to a lot of these life science investor conferences, and you've got the PhD, or the CEO who's the PhD sort of up there talking, and they get lost in the science. They've got 20 minutes, and you see the light going, and they've got 20 minutes to tell their story. Everybody in the room is an investor, so we want to hear the business of the science, and they get caught up in the science, and they've got all the fancy graphics, and oftentimes nowadays they've got the little the mice running around, and everybody's thinking, oh great, how cute. But at the end of the day, you didn't tell us how much money you wanted and where it was going to go, and what you were going to do in terms of return on the investment. And that's, I think it's more of a mindset.
Yeah.
I'm not sure if you wanted to add anything there.
There's two costs to being public: dollars, and there is a dollar cost because there are legal filings that have a certain cost every year, and there's a time cost. The CEO and the CFO have to be out there. As Raymond said, you have to have these broker relationships. And so you've got to be out there on a regular basis talking to the retail brokers, talking to the, for the early stage ones, not the fund managers necessarily, but you got to talk to the analysts, you got to talk to the bankers, and you're constantly out there raising money. I mean, you cash one check, you start your next financing the next day. I mean, that's just the nature of the biotech market. So there is a cost. There's also, as I mentioned, you have basically a subway line of events when you're developing a product. If you've got a 1 year gap, between subway stops, you got to spend a lot more time in the market talking to brokers for that 1 year period, just so that they pay attention to you. And when your event approaches, that everybody's aware of that event and that you will get some stock market reaction to the event.
One thing I sort of want to point out as well, don't make the mistake of assuming it's us versus the private marketplace. Certainly in the life sciences space, a smart company nowadays uses both simultaneously, and the listing in and of itself does not necessarily mean that you cannot go back to the VCs. Oftentimes a lot of the investors in some of these publicly traded companies are the VCs that have set up PIPE funds, or private investment in public equity funds. So you don't necessarily want to think only, well, I'm public now, I can't talk to anybody over here, which is why Wayne's comments about messaging and the valuations there apply to both sides of the marketplace. We just provide a bit more options, if you will, out there in terms of potential sources of capital. So,
U.S. VCs, I'll just, one final comment. U.S. VCs are very used to investing in public companies. Company Response Biomedical out of Vancouver, OrbiMed put $8 million into them. I think it closed in July. OrbiMed's a U.S. VC. The group that just stepped up and put potential $35 million into Protox out of Vancouver for their phase 3 trials, Warburg Pincus, that's private money. The labor-sponsored funds in Canada only were allowed to have a certain amount of their money in public companies, so there was a limitation from them doing publics, but the US VCs, no limitations whatsoever, except perhaps as their limited partnerships allow. Robert?
Great.
Okay, so a big cost, which you guys didn't mention yet, was the refundable tax credit from shreds, and particularly for an early stage biotech company losing a 35% tax credit or more is very significant. There should be lobbying efforts going on from TSX. Can you update us on any discussions with Revenue Canada about that?
Yeah, I was supposed to repeat the question for the camera there. So basically your question was about the loss of the shred tax credits when a company does go public. And that is an issue that we have had, and we're working with Biotech Canada on that one. I'm on one of their advisory panels we're looking at a number of things in that context. We've always had an issue at the exchange with the fact that we feel that companies, certainly in this space, are being penalized by the fact that they're forced to go public sooner than in many cases than they should, but because there isn't options in the private marketplace, they're damned if they do and they're damned if they don't, quite frankly. So yes, it is an issue. We are working with Biotech Canada to try and address this. I think, though, as you know, in dealing with the government, certainly at the federal level, nothing ever moves as quickly as you would hope it would. And the good thing about Minister Flaherty and his team is at least he's been in power for a while now, and he does recognize the negative impact that is having. And so he's been a bit more, he and his team, I should say, have been a bit more willing to listen to the arguments. It's been predominantly Biotech Canada that's been doing this, and we've been supporting them in terms of providing information. So I can't speak to the exact dialogues they've had, but the feedback I've had is that he is open to the discussions. I just don't know when they might do something to make any changes. I know that they're focusing more in the immediate term on the flow-through shares for the life sciences space to see whether or not that could also drive more capital into life sciences. But I think the shred question, I think, is still up in the air, at least for the foreseeable future.
I love Wayne's metaphor of the subway line, because drug development is a set of stops along the way. And these days, if you're working in a therapeutic area, there's probably a reasonable amount of seed financing available, so you can get your invention into a company, get some preclinical proof of concept, then you have to move into preclinical development. And Raymond mentioned that these days, even in the CPC space, there's like no appetite for preclinical companies. Also, there's no venture capital left in Canada for preclinical companies. So we've kind of got a power-off situation between this stop in the subway line when you get preclinical proof of concept and the next stop when you start clinical development. How do you get from that stop to the next stop these days? And I don't know if you have the answer. This is a question that comes up over and over again.
Want to repeat the question and then answer?
So the question is basically when you're at the really early stages and there's a lack of interest and a lack of funding, how do you get around that? If you look at data on partnering, one of the best sets of presentations that I've seen come out of Recombinant Capital out in San Francisco, which I believe are part of Deloitte's now. They're kind of hard to find on their website, but they do great summaries of what partnering gets done, and they're free. More partnerships get done at the preclinical and research stage of development that get done and at the later stages. And this is something which has been consistent for a decade at least. Now, it's really hard to get the attention of big pharma, especially when you have, when I said they see thousands of projects a year, when you're talking preclinical, they probably see tens of thousands of projects a year. So I would say that right now, one of the things you really have to focus on is getting partnerships with the people that have the money, be that mid to large biotech or big pharma. They have the largest sources of capital still. I'm not sure what Pfizer's got in the bank. I think it's still 15 or 20 billion. Even though you're getting consolidation and big pharma is open to this. They are consolidating their research campuses. They are cutting back. They would rather license a product or a technology than to build up a whole new infrastructure in their research groups, because they can get an answer out of an existing research group probably faster and cheaper than they can in building their own. So in the absence of, as Joe said, the VC money in Canada and the difficulty of getting the attention of other groups, I think you have to go to big pharma and big biotech, and try and get in there. And there's one or two partnering conferences every week, almost throughout the year. So I think, and you now have MaRS Innovation upstairs here, which is, focused on making that early stage introduction, and partnering and the experiment that, will hopefully get you that final piece of money.
One of the things another way to come back to your question as well is that given the role I play at the exchange was really is to act as an advisor for companies that are considering going public. I'm not necessarily sort of benchmarked by how many companies I list on an annual basis, thank God, because I probably would have been fired 2 years ago given everything that happened. But what I tend to do is act as an advisor for the companies, and certainly in the life sciences space, on almost a daily basis, I have to say. I'm always getting some sort of query of some sort as to, how do we go public, how can we get capital? And I oftentimes will work with Ross, who's sitting behind you here, in sort of approaching him and his team to see if they can help me in assessing the merits of these companies. And between the two of us, we're oftentimes able to help create some introductions to some of the investment bankers out there, get them to have a look at the projects. And it may not necessarily be something that can be funded publicly, but oftentimes they do have some very good connections into the private financing space. And what we're almost trying to do nowadays is recognizing maybe it's a long-term goal in terms of getting them listed, but in the short term, what can we do to at least create as many introductions as we can to as many sources of capital so that they at least have a fighting chance of receiving some funding out there, whether it's governmental through the SR&ED tax credits and things like that, or it's some players in the private equity or the venture capital or the super angel or the angel space. It is sort of a hard to pin down in terms of where our appetite is at the end of the day, but a well-told story will get a door open for them. And I always say, quite frankly, make sure you at least can put together a fairly decent executive summary of at least what the business of the science is. Don't get caught up on all of the scientific jargon. If you can put together a decent 3-pager and send it to us, and it looks viable based on Wayne's assessment and Ross's assessment, 10 to 1, you're going to be able to get a door open somewhere to at least speak with somebody that can give you a better sense of the financing potential in the long term. That's basically how we have to try and operate nowadays. And hopefully, I keep reading all these reports that 2011 is supposed to be a far better year for life sciences and in general, and biotech, the R&D side of things particularly, especially since all of us are keep getting older, despite what the press keeps saying about 40 being the new 30. The reality is I feel like 60 half the time, so I'm going in the opposite direction, but there is an understanding that there's some great upside R&D being done out there. It's just a question of addressing the market volatility and the market risk aversion in the short term. So we'll see what we can do to help bridge a gap as best we can. So, how are we doing, Joseph?
Good. We got about another 7 or 8 minutes.
Any other questions? Or have we completely scared everybody away? Sure.
Actually, I just had a question regarding, I hate to focus on failures, but with failures of early stage companies, would you say that they're more a failure of the science and technology, or like a failure on the business side where you don't have an adequate management team, or you have uncoachable scientific management?
There's 2 answers to that, because I think both of us are coming at it from different angles. And Wayne, in his presentation, brought up, oh, sorry, I'm supposed to repeat the question. You're asking about the failures in the space and whether or not it was sort of a failure of the science or a failure of the management. And Wayne's stat there, and the stat everybody talks about nowadays, is that for most life science companies in the R&D space, as opposed to med tech or medical devices, the clinical trial type companies, there is a 90% failure rate, and it is related to the science. For a variety of reasons, it's only 10% of them will succeed at the end of the day. So that's one side of your question. In the funding side, and certainly on the public market side, the bulk of the failures are, you can't say the bulk of the failures. Obviously, a failure of the science will have an impact if you're publicly traded, but in many cases, the larger issue is the lack of the management skills at the end of the day. Certainly when you're on our senior board, you're expected to be able to stand on your own 2 feet. You have to realize the market environment you're in, the expectations on you. And it sounds awful, and I apologize to those that may be offended, but your PhD does not necessarily mean you know how to run a publicly traded company. It means you know how to do science. And those PhDs that have succeeded have recognized that they needed to flesh out their skill set. And oftentimes they are the perfect balance of being able to tell the science and the business. And those individuals do extremely well in the space. It's those that either don't have the management skills in general or don't know how to manage a publicly traded company and all the responsibilities. It comes back to your question a little bit earlier as well. That's really where the failure rates, I would say, fall into play when it comes to the public market side of the coin.
There's one of the groups that really looks closely at successes and failures in the industry is at Tufts University. And some of their publications are available free of charge, others you have to pay for. But they go back and under confidentiality with Big Pharma, they get a look at their successes and failures for the last 10 years, and they publish like why things died or didn't die. So from a product perspective, it's about a third efficacy, a third safety, and a third market changed, economics changed. That's the reason products get killed. In terms of failures, you get some where the product just absolutely failed in a blinded controlled study. BioMS with their MS product, it just didn't work. And you get others where you're running multiple phase 2 clinical trials and you never get that data, which allows you to raise the money to move to the next stage. An example for that might be Conjuchem with their GLP-1 products. Plus the fact that Big Pharma pumping in, a couple $100 million into their programs moved ahead substantially faster. So you had Amyl and Lilly getting out there first. You had, I can't remember, there's Roche or Novartis who was in phase 3 but actually has stumbled themselves. And now you have Sanofi and Zealand in phase 3. So there it was a combination of not getting the data that allowed you to move ahead. And it's tough now when you've got limited funding. How do you in a lot of companies, small companies have survival funding, but they can't get that chunk of money which allows them to do that specific experiment or that specific clinical trial to get then the partnership or the sell the company or the big chunk of money. So it really is a mixture of things as to successes and failures these days. Some companies that are service companies or have in the diagnostic med tech, you can actually probably be profitable in the med tech space on $10 to $20 million a year in sales. A little higher if you're into bigger med tech devices. I think IMRIS is doing about $30 million a year now and is sort of break even. They're just about ready. They've announced the other day they're going to do NASDAQ listing, so they'll be cross-listed on the TSX and NASDAQ. Those are the kinds of examples you like to see where they're moving ahead.
One other thing I would throw out, and it sounds like a bit of an aside, but one other area where a lot of companies fail is that when they're actually doing the fundraising themselves, certainly in Canada, and I think it's a distinctly Canadian phenomenon, we just don't seem to have enough confidence in our abilities to either run a company or develop a science. And one of the biggest issues you see across all sectors, but in particular in life sciences, is that when they do go out for a funding round, whether it's privately or in the public marketplace, they never go out and ask for enough capital. It's almost like they're afraid to ask for what they actually need and think, well, I'll come in at maybe this amount, maybe I'll get more people interested. Almost always shoot yourself in the foot when you do that. You're almost always struggling to get the next round of capital. And as Wayne said, as soon as you finish one round, you pretty well have to start looking for the next round, even in the public markets. And so in many cases, it's quite frankly, they didn't go out asking for what they actually needed to do that particular phase of their clinical trials. And they ended up shooting themselves at the foot at the end of the day. And they could have actually had a very viable product or a science, and they just ran out of steam, ran out of capital. So I always say, in today's marketplace, even as difficult as it is, for God's sakes, ask for how much you need and top it up a little bit. If anything, if you needed 10 million, go out and ask for 15. Always better to go in asking for a little bit more, knowing it's probably going to come down, than to ask for too little, and you're probably going to come down from that as well. So.
Okay, thanks very much, gentlemen. That was great.
Thank you. Thanks, Joseph.
So just a few words to wrap up here. I really want to thank Raymond and Wayne for joining us today. They bring a great perspective on here, and they really are among the best in North America at what they do. Just a few things. Wayne talked a little bit about financial forecasting and financial modeling for your company. On December 8th, there's going to be a best practice in this room, I think, with Charles Plant, our own CFO, and he's going to be talking about getting beyond the hockey stick graph, which VCs see and just kind of roll their eyes. There really needs to be some weight behind those predictions and behind that forecasting, so it might be valuable for you. The second thing is that we've developed a a series on the Entrepreneur's Toolkit on financial forecasting and on setting up your financial modeling, and specifically for life sciences companies to do that in context of the regulatory milestones you need to reach to get approval with the FDA. So there's a regulatory workbook on the Entrepreneur's Toolkit that you can work through and align those subway stops with what the FDA is expecting from you and your company. I will also be emailing out some of these resources so you can kind of go back and talk to some of your colleagues back at your companies about what you've heard today. So thanks for spending your lunch hour with us, and look forward to seeing you at further best practices.